Okay, so before we, before I share, very quick disclaimer again, this is not meant to be a signal session, right? So the ideas that I'm presented is solely based on my personal point of view. I may have my own style and trade and risk management, right? So again, they are not meant to be trade advisory or signal advisory. Okay. So very quickly, let me share with you the overarching framework first, right? I think this is very important because a lot of traders struggle simply because they do not have the clarity when they approach the market or when they approach trading. So in my years of experience, I kind of having the opportunity and I would say the experience from observing how I trade at the same time fellow traders how they trade. I'll kind of condense it into this framework over here, right? We call it the DSC framework. Basically, to me, this is the most important trade element to achieve a profitable trade. Okay, so that don't get me wrong, this is not a strategy itself, it's a framework. So what this means is that you can be using, different methodologies, different strategies, but at the end of the day, I think you will need to have answers to this three component. Okay, and what I mean by that is your method of analysis, your trading strategy would need to have elements of this three thing. So what exactly is the three elements? What is DSC? What does it stand for? D naturally stands for direction, right? So to me, I think that's the most important first step in trading. Okay, you need to identify the high probability direction. Right, so over here, of course, it can be based on macro fundamentals, it can be based on technical analysis, it can be based on understanding the market sentiment. But the first thing here as a trader, before you even pull the trigger to take a trade, you need to first identify where is the market going, right? Which one has a high probability, whether is it upside or downside. So that's the direction. I think if today you don't have a clear sense of which direction you want to be focusing on, then you'll be trading blinded, right? Because you'll be equally like going into the market and gambling. So direction is very, very important. Okay, in a while I'll show you the methods I use to determine direction. Okay, and once you determine direction, a lot of times traders would just jump into the trade immediately, right? And that to me is not a optimal way of executing your trades, because if today you have a high probability of the market going up, but it doesn't necessarily mean that it's gonna go up immediately. Sometimes it might take some days or even a few hours before the market eventually move higher, right? And of course, you also don't want to get in and buy in the market where the price is already very high, okay? Because then your risk to reward ratio is not great, okay? So that's where the second element comes in, which is the setup, okay? And again, I'll be sharing with you the setup that I personally use to actually execute the trade. So setup over here kind of constitute to strategy, to session, to the concept of seasonality as well, which is to me essentially a set of rules, a set of conditions and criteria where you set for yourself, kind of like a checklist, right? If the market conditions kind of fulfill the checklist, that's where you are able to execute a trade. Okay, so to me, a setup essentially carries the element of time. It tells us when to get in, where to get in, when to get out, and where to get out. Right? So these two elements, the direction and the setup itself, I would say if you can kind of manage it well, right? So you have these two conditions in your trading plan, in your strategy itself, I would say you would probably win, a good chunk of trades, right? But if today you want to further increase the odds of winning, you want to increase the confidence in your trade, that's where you want to add in the third component, which I put it as context. Okay, so context carry the element of confluences, carry the element of multi-time frame, carries the element of risk to reward ratio, and to me, I sum it as context is essentially asking the question: is this trade worth taking? Right? Is this setup worth taking? The reason of this is because if today you are looking at multi-assets, okay, from currencies ranging to stock markets to commodities to index, how do you then filter and pick the best trade opportunities to be executing, right? Because if today you have like 5-6 trades concurrently on your plate, you won't be able to focus, right? And if you are not able to focus, you are prone to making more mistakes. okay, or even potentially miss out better opportunities. So you need to have certain processes to help you filter trades, and that to me is the element of context. Okay, so again, I want to give you this broad picture so that as we progress in today's session over here, as I share with you this week's trading opportunity, you'll be able to understand where I'm coming from, and as I mentioned, appreciate not only what trades and opportunities there are, but more importantly, the why. Okay, the reasons behind those trades are being developed. Okay. Now, very quickly, I'll go through the directional bias over here first, right? So, for me, I use a lot of technical analysis, and the principle behind this technical analysis is from Elliott wave principle. Now, for some traders, when they hear about Elliott wave, they would be, immediately shun off and say that, well, it's too complex. Okay, but I'll make it simple for you. The essence of it is essentially price action. The essence of Elliott wave is basically patterns itself, right? When we look at charts, and there are only two types of patterns that is relevant to us as trader. One pattern is what we call a continuation pattern, which identify whether the market trend is likely going to continue, and all we need is the other one, which is the reversal, right? So we only need two: whether the market is going to continue in its prevailing trend, or the market is going to reverse, right? So I just need two, right? I don't need to like overcomplicate the whole process. So from Elliott wave principle, we just need to be familiar with these two patterns. One is what we call impulse correction, and the other one is called impulse crawl. I'll also definitely show you an example in the real life market example, because again, what we have in drawing is very, very different from market, like real charts, right? So I'll show you the drawing first, then I'll show you the example in the market. Okay, so this is a continuation pattern. Essentially, we see an up move that is very fast or down move that is very fast, followed by a correction, which means the market going into consolidation and it takes some time to develop. Okay, so very quickly, if I bring you over to MT5, you can see examples of that as well. Okay, this is what we call an impulse move. This is what we call a correction move, right? So when you see that combination, what happens? The market continue to drop, right? So that's what we call trend continuation. Okay. So over here, same thing as well. Recent times, we have this up push, and then after that, the market starts to consolidate. Now, what do you think the next direction would likely be? Continuation, right? So that's where we establish the direction to focus. And the keyword, I call it directional bias. Okay. So again, this example on this chart is very, very clear. Okay, historically, that's how the pattern play out. It's a trend continuation. So in the future, when we see similar pattern itself, we are expecting trend continuation. Okay, so obviously it's not going to be 100%, right? Don't expect like certainty in the market. But what we know is high probability the market is likely going to continue. Right, so I'm just very, very quickly throwing out some examples in the real life charts together, right? So that's the continuation pattern to help us identify whether we have a clear directional bias. Okay. Now the other pattern over here, I'll very, very quickly kind of like scroll through this, because again, these are just drawings. Okay. So you can see impulse correction, right? So every time we see this combination, the market is likely going to continue its trend, right? So there's an uptrend, there's also the downtrend side of things. Okay. The other pattern over here is basically the reversal. Okay. So again, this one are just examples of it. Okay, so the reversal pattern is what we call a crawl. Okay, so I'm just giving it a name that kind of describe how the market price is moving. So over here, you can see the market move higher, initially very fast, and then it starts to slow down. It lacks the momentum, and therefore is indicating a potential reversal. Okay, the opposite is true. The market came down fast. It does a crawl, so it's a lack of momentum, and then after that, the market reverses, right? So again, very, very quickly, right, jump into a real life chart over here for you. You can see that as the market initially moved, this is fast, okay, and then after that it continued to move lower, but it's not as quick and it's not as strong in the momentum that it has previously came down, right? And the market starts to show sign of a reversal. Okay, now another example I'd like to highlight over here is the dollar Canadian. Okay, so I'll just play around with multiple time frames to show you clarity as well. Okay. Now you can see this initial push was fast, and the market then now starts to do a little bit of a consolidation, right? It's still going higher, but the momentum in which price is developing, you can see it's already slowing down significantly, right? So it kind of carries the element of a crawl. So what does it mean to you is that there's a higher possibility that this may actually come back down or even do a reversal, right? So when we see a pattern like that, again, you want to be cautious in buying because this is telling you the upside momentum is lacking. And there's a good possibility the market is reversing soon, right? So that's where the reversal pattern kicks in. Okay. I can show you multiple examples as well. You know, very quickly. Let me just scan through. Okay, not all charts are equal. Okay, not all patterns are equally obvious and straightforward, but you can see an element of crawl here as well. Okay, the initial move was fast. After that, the market continued to move higher, but it's struggling. And then what we get is a drop, right? So that's the pattern itself, right? So again, this is Aussie Yen, right? So Aussie Yen gives you historically what the pattern has been played out. Dollar CAD example over here is to show you something that has yet to develop, but is of a similar pattern. Okay, and that's what we do, right? We're studying basically historically how certain patterns tends to play out with certain reliability factor, which means that there's a certain probability it will, develop in a certain pattern itself, repeating itself. And what we do as traders is in the future, if you can't identify the similarity pattern, then we want to leverage on it, right? We will then expect, oh, in the past, this pattern tends to play out like that, and therefore in the future, if we see similar patterns, there's a very good odds, there's a very good chance that it will also play out similarly, right? So that's what we call pattern recognition, right? And again, Elliott wave itself, if you kind of put it into the simplest form with its essence, it's really about pattern recognition. Okay, so that's the impulse crawl again. This slides here I will just scroll through quickly, just to show you, those are some of the examples of drawings, right? Again, you can combination of impulse crawl, a reversal, impulse correction, and therefore a continuation after that. Okay, so again, these are just examples of things, right? So that's a direction. I think again, as I said, right, there are a lot of ways you can determine direction. For me, I use the Elliott wave principles to help me identify it. Obviously, in today's sharing session over here, I'm keeping things quite simple. It's not complicated, but obviously it requires practice, right? Again, if this is your first time listening to this technique, it definitely requires you to put in a little bit of effort to practice it, okay? But I would promise you that you put in sufficient practice, it's not difficult. Okay? So that's what I call directional bias, right? It's the first step for me to identify very quickly on a chart, do I have a clear direction that I can look up for? Now, certain charts will not give you a clear direction. Okay, so very quickly, let me just talk about this right now. If I jump into, let's say, dollar yen, okay, would I be interested to trade dollar yen at the moment? Not really. I mean, you have a clear pattern, but I kind of skip forward a little bit already. We have a clear pattern, but the context tells me that this is a trade that definitely I wouldn't want to be focusing on in the near term, right? At least for this week. It's not something I want to look into. Another one, gold. Hey, which is one of the very common commodities and popular commodities many traders are interested in, right? So do we have a clear direction? Now, a lot of traders say, wow, we have a strong momentum to the upside. Obviously, we are buying. Okay? But my take on this is we don't have a clear pattern, right? My pattern that I'm looking at is not just an impulse. For me to expect this to continue to go higher, I need to also get a correction here, right? It's a complete set of impulse correction. Right now, we don't have this, okay? And in other words, I'm not interested in buying at the moment, right? I don't have a obvious directional bias I can focus in the near term. Why? Because the market can easily reverse today, tomorrow, right? And what we get a V shape. And that's not a bullish bias, okay? So sometimes when you open up a chart, right, when we focus on the most recent price development, we may not get a pattern. And if we do not get a pattern, we don't simply trade it, right? We just be patient, wait for price to continue to develop. At one point in time, it will develop into something that we are familiar with, right? So again, to conclude, the directional portion first. Keeping things simple, I just need two patterns, and I'm just looking out for these two patterns. Impulse crawl is a continuation. Impulse correction is a continuation. For example, euro dollar. Okay, impulse crawl is a reversal. For example, the dollar Canadian. Okay, so that's the directional bias, and as I mentioned, just now as well. After we have a clear directional bias, the next thing we want to do is to establish our setup. Okay, now we know, let's say for example, this week I'm interested in the euro dollar as well as Aussie dollar, right? In a while I'll do a deep dive of the Aussie dollar analysis, but I'm also interested in the Aussie dollar. Okay, so when I have a directional bias, that's mean I have something to be looking out for, or something to be focusing on. But I also need a setup, right? I need to know, okay, if I want to buy, do I have a set of conditions fulfilled for me to execute the trade? Okay, if there is a directional bias but there is no setup, I don't trade it. I would want to wait for my setup to come to me, right? So why is it important to have that setup? Is because it gives you the discipline to follow your strategy, right? To follow the conditions that you've set for yourself, and you don't overtrade, right? So again, setup is essentially, to keep things simple, you just need two types of setup, right? One is to trade a trend continuation, one is to trade a counter trend. Okay. Now, strategy, if you today look into trading, there's like hundreds, if not thousands. Okay. And I just want to put it across again and remind everyone there's no such thing as the best strategy. Okay. Every strategy has its own pros and cons. You as a trader, your role is not to find out which strategy can make you the most money, but your role as a trader is to find the strategy that fits you as an individual. Okay, because if a strategy fits you, it works efficiently for you, you will make money out of it. If a strategy doesn't fit you personally, even though other people can make money using that same strategy, it may not work for you. Okay, so shift your mindset a little bit as you are testing out setups, testing out your strategy. Do not seek for the most profitable one, but seek for the one that makes sense the most to you, right? The one that you kind of comfortable with and you're aligned with it. Okay, so I'm sharing with you my setup. It doesn't necessarily mean that it will 100% work for you, but I think based on the setup that I use, general people are able to accept it because I'm not a fast in, fast out kind of scalper. I'm more of the approach of a swing trader. So we have the freedom and the flexibility of time to really look and understand before making a decision, right? You're not needing to make quick decision in the market because we're doing swing trading, as I mentioned. Okay, so over here I have a couple of setups, right? But in today's session over here, I'll very quickly walk you through one of the most straightforward and the easiest setup. Okay, and this setup is based on order flow strategy. Okay, it's based on the order flow technique itself. So very quickly, there are a couple of things that we need to very quickly explain to you before you can appreciate this strategy. But the steps are quite straightforward, right? We identify market structure direction. Okay, so in this case, on top of the directional bias, we do play around with multi-time frame as well. So when we are looking at the setup, we also want to have that alignment, right? So it carries a little bit of context, inbuilt into it as well. We want to also identify market structure direction is the same as the directional bias. Then we identify order block, which is our supply and demand zone. In a while, I'll share with you how to identify that. Okay, then we enter the trade. Near the order block, for me, I use quite a bit of FIBs. Okay, and basically we set our stop and target, right? Very, very straightforward. Okay, just some little details to explain so that you understand it. Okay. So let me share with you the model. If today we are looking to buy, this is the model of a setup. We want the market to have certain market structure break, right? So that's where the alignment in the direction from the directional bias and the market structure here, we have both bullish market structure, right? Why? We have a low, high, higher low, higher high. That's a bullish market structure. Okay, and then what we do, we wait for the pullback into our demand zone. We get involved in the trade to buy. Okay, so this is the model, but let me go into the detail, right? You flip it, you have a bearish model. Okay, So the details of here is to first understand how do we identify our order block? How do we identify supply and demand? So the first thing to understand is FVG, right? We call this fair value gaps. Now the concept of fair value gaps, if you're familiar with the US equities market, they are not 24 hours, right? So therefore, there's quite a bit of gaps that you're gonna see from day to day in the US equity market. Okay, so those gaps are essentially what we call fair value gaps, right? They are market imbalances, right? Which means that when the market closes, something happens in the market, that affects the price of the stock. But since the market is closed, the very next day when it's open, it gaps, right? So it creates what we call an imbalance because it jumped a certain price range itself, right? It can't skip a certain price range, and that's what we call the fair value gap. Now, in the FX currency market or in the commodity markets, we don't really see a lot of gaps because the market is essentially 24 hours. Okay, so in FX and commodities, we use a slightly different technique to identify these market imbalances, right? So the whole idea of market gaps is to identify market momentum, right? It's actually the same principle in the stock market. Why it has a gap? Because the markets actually jump or move to a certain price point with strong momentum. Okay, so FX here we're gonna use 3 candle pattern to identify the fair value gap, right? And just to very quickly show you the drawings as well. Okay, so you have 3 candles, and you realize that the second candle has a larger momentum. Okay, and the fair value gap is identified when the first and the third candle did not overlap. It's a very straightforward, simple model. Okay, same thing here. So the market is coming down. Candle 1, candle 3 did not overlap. Now, very quickly show you some examples in the real life market as well. Okay, so this is the Aussie dollar chart. Okay, now you can see over here, this is a very obvious strong momentum candle. Okay, and what we have is this is our first candle. The strong white bullish candle is your second candle, and then the third candle is here. And you do observe that the first candle and the third candle, there is no overlap. So what does it do? It creates this fair value gap area. You can see, right? So that's the direct application of in the market itself, right? So that's the first step to understand. Okay, if you're interested in the order flow strategy, fair value gap is the first principle you need to be familiar with. Then after that, once you identify fair value gap, the order block is quite straightforward. It's simply the first candle that created the fair value gap. Okay, so if today we are looking at buy opportunity, then we're looking at demand. Today we're in a bearish structure, we're interested in the sell, we're looking at a supply zone. Okay, so again, very quickly, same chart, that's your demand, that's your supply, right? So if I go back to this chart over here, okay, let me very quickly, alright, so I'll just leave this color here as fair value gap. Okay, which is the first candle that created the fair value gap? The first candle. So this candle would be my order block, and because we are in a bullish market structure, this order block would be a demand zone. Okay, so that's how it's being created, right? So let me just very quickly drop in some label, right? So this is your fair value gap. Okay, and the bottom over here, this is the demand zone. Okay, so that's as simple as it is. Okay, there's no need to overcomplicate stuff. So once we have this, the setup is straightforward. Okay, we have fair value gap with demand, and we simply now need to just identify our entry price, stop loss price, and take profit price, right? So if you don't use Fibonacci ratios, then the entry is gonna be based on the demand zone, right? So if you're looking at a buy, you're gonna trade off the top of the demand zone. Your stop loss is at the previous structure, swing low. Your target is the previous swing high, right? So this is how this example looks like, right? The market came back, tag it, and go. Okay, now if you flip it, in the opposite side, it's quite similar, right? Just the kind of like mirror of it. Okay, so we have same thing, fair value gap, supply zone, swing high, swing low, right? If the market pull back, that's the entry at the bottom of a supply zone, right? If you're looking at sell, Stop loss at the swing high, and then of course the target at the swing low. This example hits it very nicely and moves. Okay. Now, when I explain this, a lot of traders would immediately forget about the first step, which is the directional bias, right? A lot of traders would be very excited about the setup, about the strategy, and then they start simply opening up charts and start off by looking at the setup. That's not the right step, okay? You do not want to trade every other setup that you identify on your chart. It's not going to help you, okay? Because there will be so many setups, but they are not likely going to be like high probability setup, okay? So reminder again for everyone, the first step is not to just look for setup immediately, but the first step is to first establish, do I have a directional bias? Okay, if you have a directional bias, then only you look for the setup, not the other way, okay? The steps in which you search for things in the market is very important, because if you kind of mix it up, you'll be confused, right? You'll be looking at things all over the place, right? So I just want you to highlight on that, right? I just want to remind everyone that, because if today you're going to look at every other charts, you would find a lot of setups over here, right? So give you an example. Just now I mentioned I'm not interested in the dollar yen, but can you see dollar yen has a fair value gap? There's a demand area here, right? And then therefore you'll be also interested to buy. No, okay, because you need to first identify, are you interested in this trade? Okay, it's not the setup first. The setup is after you have an interest. The setup is to help you keep your discipline in executing those trades. Okay, so those are the things very quickly to share with you the steps. Directional bias, going into the setup, and then of course context. Okay, now context over here is a very broad topic. So today we won't have the luxuries of time to really talk about it, but very quickly I'll just explain why I'm not interested in dollar yen. Okay, now the context of dollar yen here is because number one, there are a couple of things, right? But number one, we are approaching a very obvious resistance. Okay, we are approaching a very obvious resistance. Now the logic holds, right? I mean, if the market is near resistance, why are you still buying? I mean, the upside potential is not huge. Okay, so that's one. Second thing, the market has made quite an extensive move to the upside, but we have yet to see a decent pullback. Now, most of the time, the market will do a pullback. You can see this, right? Decent upside, significant pullback. Okay, decent upside, pretty significant pullback, right? Decent upside, significant pullback. That's the nature of how the market tends to move. So in this case, we get a strong up move, but we haven't really get a decent pullback. Okay, so what does it mean? In the element of context, I'm not so confident in buying this upside. Okay, because of this kind of element, right? So would I be still interested in upside? Probably not. Would I be interested if I can get a sign where the market is telling me it's reversing? Yes, for sure, right? Because that's where we're expecting this to pull back. That's where the opportunity can come in. Okay, so that's the element of context, just to show you a little bit. Okay, hope that give you a better understanding. Okay, so now let me go into the market and share with you opportunities within this week itself that I'm personally looking at, and you can see the application of the framework that I just covered. Okay, the first one I'll dive straight in is the Aussie dollar, right? Because this one here, I think by today or even tomorrow, we may get a potential trade. Okay, now before I even dive into this, one of the element of context I look into is the events for the week. Okay, now this is also important because you want to understand, before you take a trade, is there any significant economic data that may move price? Okay, now if you're interested in Aussie dollar, then of course we'll be looking out for economic data that relates to Aussie or the dollar. Okay, so this week, if you kind of scan through very quickly, we have this quarterly GDP. I don't think that's going to be like super significant. We have the Fed chairman testifying. I don't think that's going to be like huge as well. And then on Friday, of course, first Friday of the month, we have the NFP. Okay, so now obviously NFP is important, right? So what we need to take note of is we are trading Aussie dollar, so there's dollar involved in it. And then of course, understanding that we have a major dollar news on Friday, the market may not move a lot building into Friday. Okay, because again, Friday is where things are tend to happen. People are generally waiting for that, right? But does it mean that we can't trade it? No, right? It just means that if today my trade is not triggered before NFP, and then I'm going into NFP on Friday and the trade is still not active yet, I may want to relook at the setup, right? So that's the element of context again. Okay, so very quickly, let's walk through the steps on Aussie dollar to show you why I'm looking at this trade. Okay, first step, direction. Okay, so let me put this down. Directional bars, right? Let me change to black. Do we have a clear directional bias that I can focus on this pair? Okay. Now this is a little bit advanced, but you guys should be able to still see it. It carries a little bit element of an impulse, a little bit of a pullback. Okay, if you pull the Fibs here from swing low to swing high, the market actually bounced off the 618. Okay, let me simplify stuff for you as well. Okay, it bounced off the 618, right? So that's one. Okay, now the other thing here that I look into is the principal Elliott wave suggests that the markets often move in waves of 3. So what does it mean is that we have first move up, second move down. We'll always anticipate a third move up. Does it need to do it? Not all the time, but there's a good possibility it's going to do it. Okay, so that's where we're going to put in some channel. Okay, and again, we're expecting the third move up. Right, so we have a nice little bounce off the 618. We're expecting this upside here. Looking at context again, very quickly, we have the potential profit sufficiently to take the trade to the upside. Things looks pretty good, right? Again, nothing is certain. It's just about building a case on whether I'm confident in taking that trade, right? So we have all these elements in place. So my directional bias for the week as of now is going to be bullish, right? So I've clear direction I want to be focusing. I'm not interested in the sell at the moment, especially on where price is, but I'm more interested, can I catch this upside? Okay, so we have the direction. The next thing is to establish my setup. Okay, so I think just now I showed you an example of order flow on the lower time frame. If I play around with multi time frame, my setup, I like to look at H1. H4 is for me to establish the direction. Okay, so over here we have a very obvious fair value gap, right? So again, I'll just draw in the demand zone here. Okay, for me, I also utilize Fibonacci, right? So I like to take from swing low to swing high. Okay, and I'll utilize the Fib on 71. Okay, so let me clean this up. And 71 often would be around the area of a demand zone or supply zone, as well as potentially within the fair value gap area. Okay, so I'll just use Fibs for specific entry point of view, right? So over here, how am I looking at this trade? Okay, we're looking at an entry pending order around 6500. Okay, what does a pending order means for those of you not familiar is we're basically just waiting for price to come back down. When it tags the area, we're looking to buy it to the upside. Okay, so my stop loss will be at the previous swing low, which is this point here. Okay, so that will put us around 6485. It's a very tight stop. Okay, it's a 15 pip stop, right? Which is very, very tight. Again, usually what I'll do is I'll just, since we're so near to that, I'll just extend it a little bit to factor in whatever potential spread. Okay, because the stop is already so tight, right? So anyway, that's around 6485. And then the target here, again, just at the previous swing high, right? So that will put you around 6530, right? I'll just round down a little bit. 6530 is somewhere here. Okay, 0.6530. Interesting. This take profit price is a little bit bigger in the font size. Okay, but yeah, so this is how the setup builds in, right? Okay, so again, you can see the first thing I do is not to jump in and look for a setup. The first thing I do is establish, do I have a directional bias? then only a look at the setup, right? And of course, the context over here is to also identify, in terms of risk to reward ratio, is it worthwhile? Okay, so very quickly, in a visual perspective, you can see that's the potential profit target, okay, and the stop would be somewhere here. So I think it's quite obvious the risk to reward is very positive. Okay, to me, anything that is less than 1:1 is not a trade worth taking, right? Most of the trade I take is easily 1:2, right? So in this case here, is about close to 1:2, about 1:1.8, which is potentially okay, right? So Aussie dollar is naturally one of the trade that I'm looking this week. Okay. Another one very quickly to bring your attention to is actually the Euro Canadian. Okay. So Euro Canadian over here is not giving me a setup yet, but it's potentially giving me a direction that I can focus, right? So again, be very clear on the steps. Why I have a directional bias? Because first thing, in a little bit of overlap of context, right, as we walk through some of these things here. Price actually came into this resistance zone, had a pretty nice little decent bounce. From Elliott wave perspective, we have a 5-wave structure potentially completed as well. So we're expecting again a significant pullback. Okay, so the direction to me is quite clear. I'm interested in this move. Okay, and of course the market put in our first move to the downside. First move to the downside. This is probably doing its correction pullback. I'm expecting the third move down. Apologies on that. So again, I have a clear sense of direction, but if I go down to the hourly, do I have a setup at this moment? I don't. Okay, not with the order flow, not with Elliott wave yet. Okay, so this example in EuroCAD is a trade that I'm interested in to monitor for now, for the week. Maybe the setup will come to me on Wednesday, Thursday, okay, but definitely not now, which means I won't put in an order to take this trade at the moment. Okay, so there's another example to illustrate the framework. Now, Euro dollar as well, I'm interested in upside, right? I think this is very clear. Okay, so the direction is there. Do I have a setup? Okay, now if I base on Elliott wave or even the order flow setup, order flow, there isn't much. Okay, there isn't much there. There is a little bit over here, but again, this fair value gap is really too small for me. I'm not interested. Okay, instead, I would rather focus on this, right? So Euro dollar, I don't have an order flow setup, but if today one of your setup is to trade the breakout of a trend line, you have a valid setup. Okay, so again, as I mentioned, setup comes in many different forms, right? It's at the end of the day, it's a set of criteria and conditions that you are aligned with. Okay, so what's a potential trade on Euro dollar over here? Okay, I'm utilizing a little bit of FIPS here as well. Let me give you a more conservative target. Okay, and use the 127 extension. Okay, just to be more specific, 127.2. So we can use that as a potential target. Okay, so what does this setup looks like? Okay, we have the impulse move, we have the correction. Okay, we have the correction. So what we're expecting over here is upside. Now, if the market can break out of this minus swing high at 1.0855 impulsively, okay, that will open up a possible trade with a stop below that swing low, 1.0795, and a potential target here, 1.0940. Okay, so again, the risk reward is slightly more than 1:1, makes it acceptable, right? But then again, the question is a breakout trade or a breakout setup part of your trading plan? Okay, now I don't trade a setup like that, right? So can this work out? Maybe, it might, okay, because it's a valid setup, but it's just not my style. Okay, so I just want to really show you the application and the discipline going into trading, right? It's not just about, oh, I have a buy opportunity and therefore I just buy it, right? Why do you need to have a proper process? Is so that you can be consistent in your action. You can be consistent in your discipline, consistent and disciplined in your decision making process. Now, why that's important again? Because if today you can't keep things consistent, you would have no idea what are the elements that contribute to your winning. Okay, and if you have no idea what is going to contribute in your winning, you can't repeat that process, and therefore you don't have an edge, right? An edge is essentially knowing what are the things that you do that will contribute to you having a higher probability of making money, right? So if things are not clear to you, you can't repeat it. And you can't repeat it, you don't know what's happening, you don't know what's contributing to your winnings, you don't have an edge, right? So again, all these steps are very, very important for all traders. Okay, so I hopefully give you, not just what again, okay, not just what trade, what opportunities, but I think more important is the why, right? The reason behind, the processes behind.